uh, continue with number 51. For 20x4, consolidated net income will be by what amount if the intercompany sale was downstream. So we have now P company's net income of 180,000. Then we deduct the unrealized profit in ending inventory of 3,000. We have 177,000. And S company's net income from own operations given at 76,000. We have the total consolidated net income for 253,000. It's still letter A for number 51. Then in number 52, if the intercompany sale was mentioned above was an upstream sale, what will be the reported amount of total sales revenue for 20x5? So we now have the answer to number 52, the combined 20x5 sales of 580,000 plus here we have 580,000 and then we are adding 445,000, so that is in 20x5. So in 20x5, we have 580 given and 445. We have 1,025,000. There was no intercompany sales because there was one, but only it was made in 20x4. So no more in 20x5. Consolidated sales for number 52 is letter A. Then 53, if the intercompany sale was an upstream, total amount of consolidated cost of goods sold by 20x5 will be. For number 53, combined cost of sales is 480,000. Then we have to deduct the unrealized profit in the 20x5 beginning inventory from 20x4. Now we are deducting because we are computing for consolidated cost of sales. So we now have the amount of 477,000 in number 53. Next problems, I will just share screen the remaining problems after this. So for the meantime, let's just continue with some of these problems before I will share screen the rest. So we have now the long problem here, number 92 to number 97. 92 to number 97. 92 to number 97. January 1, 2004, Pride Incorporated bought 8% of the outstanding voting common stock of Strong Corporation for 364,000. Of this payment, 28,000 was allocated to equipment with a 7-year life. So that's 364,000 difference of 336 equipment with a 7-year life. So meaning there will be an amortization of 4,000 a year. And that had been undervalued on Strong's books by 35,000. So again, we have an undervaluation. Any remaining excess was attributable to Goodwill, which had not been impaired. So December 31, 2004, before preparing the consolidated balance sheet or consolidated worksheet, financial statements appeared as follows. So we have now revenues from Pride and Strong, revenues, cost of goods sold, operating expenses. So we have net income. Then we have retained earnings. Beginning, we are adding net income, retained earnings at the end. Cash and receivables, followed by inventory, investment in strong corporation, equipment net, total assets. Then for liabilities, common stock and retained earnings, total liabilities and stockholders' equity. During 2024, Pride bought inventory of 112,000 and sold it to Strong for 140,000. So the cost is 112 and the selling price is 140. So initially, Pride bought inventory and sold it to Strong. So in this case, Pride here is the parent. Okay, Pride is the parent, and so Strong is the subsidiary. If Pride Design is the seller of the inventory to Strong, in other words, we involve a downstream sales. Only at the end of the year, 60% of these goods were still in the company's possession, 1,000, and 60% thousand are still in the inventory at the end of the period. Revenues in number 90. Okay, so we are now asked in number 92 to determine the total of the consolidated revenue. So we have now the sales of T company and Strong company for a total of 700,000. Then we have the intercompany sales of 140,000, the consolidated sales after deducting the intercompany sales. We have the consolidated amount of 560,000. Then number 93, what's the total of the consolidated of. So we now go to number 93, the total of the expenses, and we have to add the undervalued equipment now for 5,000. The fact that it's undervalued, the depreciation was understated. So now we are adding the adjustment in the amount of 7,000 a year, so 5,000. That gives us the consolidated expenses equal to 47,000. That's letter B. And number 94, what's the total of the consolidated cost of goods sold? So we now have the cost of goods sold of 196,000 and 112,000 or 308,000. Then we deduct the intercompany sales in the amount of 140,000. And we have now the adjustment for the ending inventory. The amount of merchandise sold by the parent to the subsidiary was 140,000. However, 60% of this are still in the ending inventory. So 140,000 times 60% or 84,000. That's the ending inventory at sales price. And we have the cost of this, no? So the ending inventory, and we multiply it by the gross profit rate. So 140 is selling price. The cost is 112. So we have the difference of 28,000, and 28,000 we divide it by 140. So we now get the rate of 20% of the ending inventory transfer price. So we now get 16,800. Considering that in number 94, we are asked for the consolidated cost of goods sold. So whatever amount of the unrealized profit, we are adding 16,800. So we now get the total as the consolidated cost of goods sold in number 94 of 184,800. So our answer to number 94 is letter C. That's the consolidated cost of goods sold. Now, in number 95, we have to determine, in number 95, we have to determine the consolidated total of the non-controlling interest. Consolidated total of the non-controlling interest operating on the balance sheet. So, in number 95, we have the amount of, in number 95, if we use the full goodwill approach. So the answer will depend as to whether full goodwill or partial goodwill is used. That's why number 95, the answer is either A or E. So if we have the non-controlling interest in partial goodwill to be computed, the common stock of S company is given at 140,000. That's S company. Then we have the retained earnings of S company for initially it was for 210,000. That's the retained earnings initial, and then we are adding retained earnings of S company. So we have retained earnings S company December 31, 20x4, and retained earnings of S company on January 1, 20x4. It's given in the amount of 210,000, and we are adding the amount of net income in the amount of 154,000. That's why you are given the total of strong corporation for the outstanding voting common stock for 364,000. Then we deduct 0 for dividends paid, not given. So we have now the stockholders' equity of S company for 504,000. That was on December 31. To the stockholders' equity adjustment to reflect the fair value undervaluation of us for given above is 35,000, and we have the amortization good for 1 year in the amount of 5,000. Now we are dealing with 35,000, the amount of the undervaluation So we have now the fair value of the stockholders' equity on December 31, 20x5, and you multiply it by the non-controlling interest of 20%. We have now the controlling interest for partial goodwill, and we add non-controlling interest on full goodwill for 70,000 minus 56,000. So we have now the non-controlling interest. So 70 minus 56 or 14,000. We have now the non-controlling interest under full goodwill for 120,800. That's the consolidated total of the non-controlling interest appearing on the balance sheet. So number 95 is letter A under the full goodwill approach. Now, if on the other hand, you will be using partial goodwill, so we now have the consideration transferred, and we deduct the book value stockholders equity of S, the common stock 140,000 times 80% or 112,000, retained earnings beginning 210,000 times 80%, and we get 280,000. We have to deduct from 364, so the difference is 84. Then we have to record the increase in equipment at 80%, so we get 28,000. This 28,000 now is the increase in equipment, the share of the. So we have now the amount of under the partial goodwill. No? So we have non-controlling interest under full goodwill is 120,800, since others a difference of 14,000 on the non-controlling interest. So we now go to the partial goodwill approach when we have the positive excess in the amount of 56,000. Uh, then we have under the full goodwill approach, there is a positive excess in the amount of 70,000. So 95, the answer is either A or E, 120,800. Then we go to number 96. The consolidated total for equipment. We have the answer in number 96 as letter D. We are now looking for the consolidated total. So in number 96, we have now P company's equipment for, here, the total of the P company's equipment for 616,000, and that of S is 420, so total 1,036,000, and then we have an undervaluation. We are adding 35,000, and the depreciation on the undervalued equipment for 1 year, 7,000. So the consolidated amount for equipment in number 96 is 1,064,000. Now in number 97, what is the consolidated total for inventory? Inventories are P company 210, S company 154. So the total is 364,000. Then we deduct the unrealized profit in ending inventory, 140,000 times 60%. Then we have 84,000 times 140 minus 112 over 1.4. So we have the unrealized profit of 16,800, which we deduct from the inventory value. That's giving us the consolidated inventory value of 347,200. Now we go to numbers 104 up to 115. 104 up to 115. Right, 104 up to 100. Use the following information for questions 104 to 115. The company, a 90% owned subsidiary of Posito Corporation, sells inventory to Posito at a 25% profit on selling price. Now, Posito is the parent and Gargiulo is the subsidiary. So the subsidiary is the one selling merchandise to the parent. In other words, this is an upstream sale. The following data are available pertaining to intercompany purchases. It was acquired in January 1, 20x3. Now we are given the year 20x3. We have now 20x3, 4, and 5. Then we have the purchases by proceed to the parent, then the ending inventory in its books. Assume the equity method is used. The following data are available pertaining to Gargulo's income and dividends. So we have now the net income for 3 years and the dividends paid for 3 years. In 104, compute the income from Gargulo reported on Posito's books. Okay, so in 104, we have now the share in net income in 20 x3, x4, and x5. So given are the amounts of net income of Gargilo, 70,000, 85,000, and 94,000. So we have now the non-controlling interest in net income of the subsidiary. So we have now is company net income. We just copy the given figures. Then we have the realized profit on the beginning inventory of P with upstream sales in 20x3. So we deduct 300, we add it to 20x4. In 20x4, we deduct 1,000 and add it to 20x5 and again deduct 750. And remember, we are computing now for the net income of the subsidiary. So we have also the unrealized income. As company realized net income from separate operations. And we have now the amortization of the allocated excess equal to 0 and the non-controlling interest is 10%. Okay, it's only 10%. Now we have the non-controlling interest in net income, partial goodwill. Then we have the non-controlling interest. The non-controlling interest on goodwill impairment loss or on full goodwill, non-controlling interest in net income, non-controlling interest net income or full goodwill. So in 105, the question in 105 is the income from Gargulos reported on Pisitos books for 20x4. So in number X 104, the answer to number 104, okay, is letter B. In 104 is 62,730 as computed the income from Gargilo reported on Posito's books. So now we have the breakdown. In 20x4, we have 75,870. So it's letter number 105. It's letter C. Then 106 for 20x5. It's 84,825. It's letter D for number 106. Next, in number 107, the non-controlling interest in the net income that we have computed also. So the non-controlling interest net income number 107 is letter A, 20x3. Then 20x4 is 8,430. That's letter C, 108. 107 is A, 108 is C, so that would refer to the year 20x4, 8430. And the number 109 for 20x5 is 9,425. 5, it's still letter C for 109. Then we go to 110. The answer is what amount would be debited to cost of goods sold for consolidation in 20x3. So in number 10, you refer to letter C. Then that's number 110. It's letter C in the computations, right? So 110 now, the requirement of the problem in number 110 is to determine the amount that would be debited to cost of goods sold for consolidation in 20x3. So number 110, it's letter C. Again, we refer to the computations in number 107. So let's go back to the computations in number 107 when we are using this information for 110, 111, and 112. So what amount should be debited to cost of goods sold for consolidation? 110, we have letter C at 300, then 111 is still letter C for the amount of 1,750 for number 112 for the amount of 750. So we are through with 110 C, 111 C, and number 12 is still C. Next, for 113, uh, for consolidation purposes, what amount would be debited to retained earnings for consolidation in 20x3, 20x4, and 20x5? 113. Since intercompany profit starts only at the end of 20x3. Then number 100, that's number 113. So the amount in number 113 is letter A. Then for 114 in 20x4, the amount of unrealized profit at the end of 20x3 is still letter C. And number 115, what amount will be debited to retained earnings for consolidation in 20x5? So number 15 is still letter A, the amount of unrealized profit at the end of 20x4. So the unrealized profit at the end of 20x4. So again, for 116, again I'll repeat number 112, a letter C, 113 is letter A, 114 C, 115 is A, then 116 to 120, now we involve separate problem for this. Next, we have another long problem. Let's take up another long problem before we go to the multiple choice theory and multiple and true false. We have 121 to 132. So 121 so far, 121 up to 132. January 1, 20x0, Power Company purchased 80% of the outstanding shares of sub-company by paying 340,000. Sub-company's common stock and retained earnings on this date amounted to 150,000 and 230,000 respectively. Also on this date, an equipment is undervalued by 20,000 with the remaining life of 10 years. On January 1, 2002, sub-company had 150,000 of capital stock and 300,000 retained earnings. Also on the same date, Par Company had 1 million in capital. While on December 31, 2022, 30% of the intercompany sales remains in the ending inventory of the purchasing affiliate. The beginning inventory of Par Company includes 2,500 worth of merchandise acquired from sub-company, on which sub-company reported a profit of 1,000, while the beginning inventory of sub also includes 3,000 of merchandise acquired from Par Company at 35% markup using cost method. The following selected results of operations were as follows. So in the books of Par and Sub, shown are dividends paid, net income from operations, dividend income, and net income. The dividend income for 20x2 should be. So we have now in 20x2, while we are given, while the beginning inventory of 4. So we are now given the data for 20x2. In number 121, the dividend income for 20x2, we have the amount of dividends paid by sub-company of 10,000 multiplied by 80%. So the dividend income of Par Company is, as given, is 8,000. The ownership of Par is at 80%. Then number 122, we have now letter D. In number 122, the balance of the investment as of December 31, 2022 should be. So we have now in number 122, it's still at the original cost using the cost method. Number 123, the non-controlling interest in net income of 20x2 should be in number 123, date of acquisition, the fair value of the consideration is 340,000, then the book value of the stockholders' equity of the subsidiary is 150,000 plus 200. Yabayo oras. Doro mana, ay te, kung mapaduin, kanyang gawa na to. Okay. So we have now the in number 123, the allocated excess of 36,000. In the undervaluation of assets, we have the difference of uh, 40, no, 20,000. So 20,000, and we have the 80% ownership. So we have now the difference of 20,000, and we multiply it by uh, 80%. So we get for the undervaluation of the assets. So that gives us the undervaluation in the amount of 20,000. So we now get the goodwill equal to the difference 20,000 divided by 80%. So we have under the full goodwill it's 25,000. Then we have the amortization of equipment for 20,000. Then we have the life of 10 years, so it's 2,000 per year. Now, for the realized profit in the beginning inventory of S, for the downstream sales, we have 3,000 multiplied by 35%. For the realized profit on the beginning inventory of P, because both made sales to one another. So given is 2,500. Then we have now the unrealized profit of S in the downstream sales. Sales of parent 60,000 times 30% inventory left. So you have 18,000 times the gross profit percentage. And the unrealized profit in the ending inventory of parent for the amount of 60,000 times 30%, 18,000 times the gross profit rate of 20%. So we have 2,400. Now the consolidated, actually we are trying to answer number 121. So the answer to number 121 is letter C for 8,000. Number 122, it's the original cost. So we have letter D. In number 123, it's still letter D for 5,320 for the non-controlling interest. So number 23, 123. It's letter D for, okay, the amount of 5,320 there for the non-controlling interest. That's number 123. 124, the profit attributable to equity holders or parent. So number 124, now we have letter B. So 118,730, 118,730 as computed in number 123. There, the consolidated net income for 20x2 is 124,050. That's requirement number 125, and so part of it is the controlling interest. Now, in number 126, we are asked to determine the stockholders' equity of the subsidiary on December 31, 20x2. Okay, number 126, it states refer to number 128. So the non-controlling interest in net assets, we have the common stock of subsidiary 150,000. Then we have the retained earnings beginning. We have the net income of S and the dividends. So we have now total of dividends deducted. So we have the net amount of 320,000. That's the book value of the stockholders' equity. So we have now the total of 470,000. Then we have the adjustments to reflect fair values of net assets, 20,000, and we deduct the accumulated amortization, 2,000 times 3 years, 6,000, we have 484,000. Then unrealized profit on the ending inventory of 2,400. We now get the non-controlling interest rate of 20%. The non-controlling interest partial is 96,320, and we have on full goodwill is 101,320. So the answer to number 126, which is already stated in number 128. So number 126, we have letter D. Number 127 is letter C. And number 128 is letter A. So 126, we have the amount of 470,000. Book value of stockholders' equity is December 31, 20x2. So that's the answer to number 126. Then the non-controlling interest in net assets using proportionate basis or partial goodwill is 96,320. On full goodwill it's 101,320. Then number 129, we have to refer to number 130. Preferred solution. Since what's given is the retained earnings beginning, so we have now the retained earnings. Number 130, retained earnings of the parent beginning. Then we add unrealized profit on the ending inventory of S. So we are adding, and we have now the attribute adjusted retained earnings of the parent on January 1, 20x2. We have the retroactive adjustments to convert cost to equity for purposes of consolidation. We have now the parent share of adjusted net increase in subsidiaries retained earnings. So the retained earnings as subsidiary on January 1, 2020, and we have the balance on January 1, 20x2. Okay, 300,000. So we have the increase in the amount of 70,000. Then we have the accumulated difference. So we have now 70,000, and we have the amortization for 2 years, 4,000, and the unrealized profit on the ending inventory of 1,000. So 65,000 we multiply by 80%. So we have now 52,000 added to the retained earnings of the parent. So we have now the retained earnings on January 1, 2012 under the equity method, consolidated retained earnings. And the profit attributable to equity holders of parent, we have now dividends in the amount of 60,000. So we have the total, deduct the amount of dividends. Or if retained earnings is not given on January 1, 20x2, then retained earnings parent on December 31, 20x2 should be used. Okay, so we have now the amounts for the last numbers. So what are now the letter answers? Let's begin with now for 130, we have letter D. For 131, we have letter D as in boy. So the answer is 1,000,000. That's number 31B. And 132, 1,911,000. Okay, we stop there, and we still have the answers to the theory, the true or false, and the true or false, 1 to 22, and true or false, and multiple choice theory, beginning with number 23. Anyway, you have the answers up to number 80. Now I'm going to share screen everything beginning from problem 1, what we have discussed or what we have not discussed. I'm going to share screen so you'll have complete answers to the problems. Beginning with problem number 1, that's in chapter 4. On Monday, we are going to begin with chapter 5. In chapter 5, you read chapter 5. I'm going to get my short quiz from chapter 5. And we will be discussing chapter 5 on Monday. So again, that's another long chapter to be followed by chapters 8 and 15 for the remaining two topics. Okay, I am going to repeat from the solution of problem 1, share screen from problem 1 up to the last problem in the multiple choice problem. So you'll have a complete set of solutions. Now we begin with the multiple choice problems. We have now problem number 1. Okay, so that ends the solutions to the problems in chapter 4. See you on Monday for the short quiz and the discussions of chapter 5.